All right, everybody, welcome to our 2016 Energy Opportunities Report and Outlook. I'm Tom Gentile. Glad to have you guys here. I have got an entire cast of students and traders in the room. We've got some brand new folks in the room that are here for the very first time listening to me. We have some folks in here who are partners that are going through my 2016 partner program, which is like the kitchen sink when it comes to what it is we do here. And then we've got some folks in the middle. All right. So welcome to all of you. All of you are going to learn something tonight. I guarantee you that I've got a minimum 3 different case studies that I want to show you involving 3 different strategies on a couple of different ETFs in the marketplace. I'll explain what I'm doing there as well. Lots of stuff I want to cover with you. I do not expect this webinar to last longer than an hour. All right. So I'm hoping I have this all wrapped up by the top of the hour so that we can all run to our television sets and watch the CNN Democratic debate, because it seems like every time I'm doing a webinar, we got a debate going on. Is it me, or do we just have severely too many debates happening now? I've never seen this many of them going on. Before I begin, though, let me call your attention to this disclaimer here. The session is being recorded, and you're able to read this from top to bottom, left to right. But I just want to point out a couple of things while we're on this page. Number one, biggest one, is stock and options trading has large potential rewards, but also large potential risk. You must be aware of these risks and willing to accept them in order to invest in the stock and options market. Now, what we're going to do tonight is we're going to talk about some patterns in the market, some cyclical patterns that happen in oil, and what I call a high probability, high historical trading pattern. Right. This is one that I've been looking at year after year, and it's looking really good, not only because of us coming into the pattern, but also the price of oil. The reason I'm saying that is that we are rules-based traders. All right, that means that we look for a set of rules, we back test them, and then we trade them. And backtesting uses simulated data. It uses quantitative, and we do what's called quantitative analysis. We look at data in the past. We look for rules. We look for patterns. We try to find ways that we can exploit the market and make money. That being said, when you're back testing, sometimes you could run into lack of liquidity, which could over or undercompensate your results. And by saying that, past performance is not indicative of future results. The last thing I want to mention here is that me, Jay, and everybody else associated with Tom's Trading Room LLC, we are your educators. We're here to educate you to take control of your own money. All right, we're not your brokers. I don't give investment advice. What I do here is I educate. Keep in mind that you need a broker to trade with, and you must meet certain requirements. And everything I'm going to talk about tonight is in U.S. dollars unless noted otherwise. And that is the disclaimer. So, questions. If you have questions throughout the session, feel free to put them in the Q&A box. I can tell you right now, we got a bunch of people in this room tonight. It is pretty close to a packed house. The maximum that I can get into a room like this. And therefore, I'm going to tell you right now, I'm going to apologize to you right up front, because we're not going to be able to get to everybody's questions, but we'll try to find the most popular ones, and Jay will be hitting me up with those throughout the session, and I will answer as many as I can within the allotted time frame that I am promising you tonight. For those of you that are new to me, and you've heard of me, but you haven't heard from me like you are right now, I just want to kind of give you a quick little background. So I started in the markets. I actually started at the American Stock Exchange back in the early 90s. All right, and from there I learned how to trade options. And so I traded options before I hit the American Stock Exchange. It's just I didn't do a really good job of it. All right, so I moved to New York and lived in a studio apartment, which was a couple of blocks from the Amex. And so I learned the option markets off the floor of the Amex. I also am the former co-founder of Optionetics. And I say former because still people are asking me, hey, you still with Optionetics? No, unfortunately, my contract ran up from the company that acquired the company that we merged with. And so they decided not to renew it. And we said our farewells, and everything was mutual. It was great. But yes, from there, I've written a couple of books since then. I'm the author of several books in stock index and options markets. I write for Stocks and Commodities magazine. In fact, this month, the February edition of Stocks and Commodities magazine is a full page spread on our tools. It was a page spread, and it was really dealing with something that I called a money calendar, but it was part of a spread that the editors did, and the folks that go through and rate software. And they did a really nice review on tomsoptiontools.com. I've done TV in the past. I don't do a whole lot of it because I don't like being in the Hollywood squares and getting 5 seconds of airtime when it takes you an hour to drive to the studio and an hour to drive back to your office. So, I've done it before. I might do it again. But the one thing I have been doing is I am now a weekly talk show host on iHeartRadio. Most importantly, I'm the founder of tomsoptiontools.com. And we're going to be using tomsoptiontools.com tonight for the 2016 oil outlook and along with those trades I promised you. So what's going on with oil? So, I've got a 22-page report that I'm going to give each and every one of you. All right. It is a detailed report describing exactly what we're talking about in here. And I think I might have another trade or two in the actual detailed report. But the fact of the matter is that I could sit here and clamor all day long about what's going on with the price of oil. I think today, Saudi Arabia just came out, and I believe it was around 2 o'clock this afternoon, and said that they are considering cutting the production of crude oil. And of course, that made crude oil stop in its tracks at $26 a barrel and turn around and start running upward. And we're actually as of right now, we're about 5% higher tonight, all right, in the overnight markets. So we'll see. What I'd really like to see in this market? 2 or 3 days of going in the same direction, that besides down. I would like to see some moves to the upside. Looks like the overnight markets are reactive positively to this news as well. But we'll see if it's a one-day thing, if it's a dud or if it's going to be something that's going to have some merit. So, rather than me go through and speculate why oil is a great bottom right here, the fact that most countries are producing it for more than $35 a barrel, and right now it's trading at, in the mid to high 20s. To me, it becomes intrinsically valuable here. But I'm not going to get into a whole lot of that with you because that could take up much of the time that I have with you today. What I'd rather do is talk about the pattern that I want to show you and what we can do with it. So my 2016 energy plan is very simple. And so what I've got here is I've got a typical trader's action, and let's assume the typical trader is onto this pattern and thinking that, wow, this is a great buying opportunity. They may go out and buy oil related stocks and ETFs and hold it until about mid-July. All right. Now, my problem with that is this. First of all, you have to know what oil stocks. You got to go do some fundamental research and make sure the company you're going to buy isn't about to go out of business, because there will be some that do. All right. The riskier oil drillers, all right, the smaller oil companies, even some natural gas companies are on the verge of bankruptcy right now. So you got to know which ones are the ones that are going to become the players. The big ones are probably one of the easiest places to go because, the big guys like ExxonMobil, Chevron, they're in a position where they may scoop up these little guys in either a bankruptcy court or a fire sale, or before they had the bankruptcy, and pick them up for a nickel, 5 cents on the dollar. So long term, they may be good, but are they going to move with the price of oil if oil does go higher? All right. Some of these companies do not have the correlation to oil as well as others. My action plan is a little different. Oh, and there's also the cost of ownership. If you buy 100 shares of stock and you're going to be holding it, I think I've got kind of a better plan, and that involves options. And I want to rent these stocks by trading options on ETFs like OIH and XLE. And I'm looking to hold these for a 6 to 12 month period. All right. The cost of renting is going to be at least 90% less, and in some cases 98 to possibly even 99% less than owning the stock. And I will show you a trade tonight that you should be able to, that as of now, we're talking about less than the cost of a decent dinner, not even a good one. All right. I'm not talking about Ruth's Chris or Fleming's. I'm talking about Outback. We're talking about that kind of trade. And I'll get to that. But we're talking about creating trades with less cost, less risk, and a better potential return on investment. All right. And option trading right now, I believe, is one of the best places to be. And the reason why is this: with this market slinging around like it is, why would you want to have thousands of dollars tied up in a financial stock, all right, or thousands of dollars tied up in an internet stock, all right? Because if it's amazing how many stocks have dropped 30 to 40% just this year alone. When you could have had an option and it probably would have went bad too, but maybe you would have lost, instead of 30 or 40 points on a $100 stock, maybe 4 or 5. All right. So, what options really give you the ability to do, if you treat them correctly, is they allow you to have much more cash behind you for other trading opportunities. Okay. So, the energy cycle is a very simple cycle. All right. I've been following this one for years. And statistically, the oil market is typically weaker between July and February. All right. So, between summer and winter, we are weaker. Between winter and summer, we are stronger. All right. So, we're gonna trade the stronger cycle. All right, because that's the pattern that's coming up here after this weekend. So this pattern has repeated itself and has happened 9 in the last 10 years on the price of oil. Okay. And so I'm going to show you that chart in just a moment. As we go through here, we want to make sure. And I say when. Well, the pattern typically starts on February 15th. Now, February 15th is a Monday. Okay, and we can't trade on Monday because it's a holiday. It's President's Day here. But Tuesday morning is when statistically the trade would go on for this year. I will be putting my trades on Wednesday because I will be giving you a 24-hour head start. In fact, I'm giving you more than that. I'm giving you a 48-hour head start in case you decide that you are going to look into these opportunities for yourself going forward into tomorrow. All right. But 9 of the last 10 years, take a look at this pattern here. So this is a long-term chart of cash crude. All right. And so what you see here is you see these green boxes every so often. Every year has a green box in it, except for 2012. And these green boxes represent mid-February to mid-July, all the way through. Some of them are bigger, longer than others, which mean that was a really good year for crude oil. Some of these were very skinny. In this case, we ran up and we came back down and we closed near the top here, but it was very little that was taken out of that oil trade for that particular time period, 2010. All right, in 2012, the pattern did not work. In fact, it came in, it went up in mid-February to mid-March to April, and then bang, got hit really hard, and then come mid-July, it came back, but it didn't come back anywhere near where it started. All right. Of course, 2013, 14, and 15, the pattern worked. As you can see here, we're looking at cash crude. We're not looking at particular oil stocks, all right? Because the pattern, again, is coming off of a barrel of crude oil. From there, we'll then try to disseminate what stocks and what ETFs make the most sense. So, one of these I think that makes the most sense is something called the oil services holders, all right, or market vectors. The symbol is OIH. OIH is made up of the top 25 publicly traded companies that are oil producers here in the U.S. All right. The other thing I like about OIH is it's diversified. All right, which means that it's a great way to take advantage of the increase in the price of oil because it's the producers, but it's diversified between the top 25, which means the top 25s, most likely all 25 of them aren't going to file for bankruptcy. In fact, most likely most of them will not. So the fact of the matter is we've got a good core group there, and we're not putting risk into any single one of them. All right, now, a question that has come up that I want to ask right away, and I want to answer is, why not trade USO? USO, isn't that like trading crude oil? And the answer is yes, it is. And the reason we don't want to trade USO is because of two reasons. Number one, USO is based on the actual commodity crude. All right, the actual crude oil product itself. It's mostly crude oil. There's some other distillates in there, a little bit of gas, but mostly crude oil. So here's the problem. Number one, you've got an ETF, which is USO, which constantly has to be maintained by managers who every month have to go in and take a look at the outstanding number of shares and make sure that they have bought enough futures contracts for the price of crude to mimic the price of crude. All right, it's kind of hard to understand, but think of it like this. The best way I can describe it to everyone here is that you know how you keep from running out of milk in the refrigerator. You're always going out and replacing it. You can't go out and buy an entire refrigerator full of milk because it will expire. It'll get disgusting. So you got to constantly replenish that milk as it's being used. Same thing happens with USO. You constantly have to replenish these oil contracts with new contracts. And the problem is that if you're an option trader, let me ask the question to all of you out there. Which option has the most time value in it, or most time decay in it? A 30-day option or a 1-year option? Which one has more time decay in it in a 30-day time frame? The 30-day option or the 1-year option? And for those of you that answered 30-day, it's correct. Now, that was kind of a trick question, all right? And I said that to see who was listening to me. The 1-year option might have more time value. It might cost more, but the time isn't going to erode on it as quickly as a 30-day option. A 30-day option will lose its time value in 30 days. A 1-year option, it's going to take a year to lose all that time value. And when you buy a 1-year option, let's say you buy 12 months of time, you're not paying for 12 30-day spots. All right, it's kind of like buying in bulk, and so you get a better price when you go out longer. So here's the problem with USO. Those managers of USO go out and buy 30-day the front month futures contracts every month. They're buying the highest amount of time premium or the highest amount of futures premium that they can, and it drops it down to cash price every month. So where am I going with this? Here's the thing. If you want to check something out really interesting, watch a barrel of crude and then watch USO and look at the percentage change every day. All right. What you'll see often is when crude goes up, USO doesn't always go up as fast. But when crude goes down, USO goes down actually more in percentage. And it's because they've got what's called that contango risk. And that's that risk of constantly purchasing these short-term contracts that are expiring. All right. And so just want to make sure you realize that. That's number one. The other thing, too, is that isn't short-term options, am I saying this right? Isn't or aren't short-term options expensive right now because of the implied volatility? Yes, they are. Another reason why you probably don't want to look at trading the short term. So that's why we're looking at this 6-month trading pattern. It has lower volatility because we're not dealing with the front months. And number two, we're looking at OIH as an example of a way of diversifying that risk. So my target on OIH, all right, if we're looking at OIH, and let's take a look at OIH. So I'm going to jump out of here for a second. I'm going to pop into our Tom's Tools, and I'm going to go over to stocks and charts. I'm going to show you a stock chart here. And we like our stock charts because we're able to do a couple things with them. Check out OIH. This is going to be the last 40 days, which is a little more than, it's about the middle of December to where we are now. Want to add one more piece on here. We're going to add the 7 to 30-day implied volatility. So I want you to look at the IV on this. This is the implied volatility, which is spiking up, and would everybody agree that it's actually high? I mean, look down here. We're talking about left-hand side is the stock price. Right-hand side is the at-the-money implied volatility. Down here was the mid-30s when we were in toward the end of the year. Now we're trading at mid-50s. This tells me that the options on the short-term side are trading. They're very expensive. All right, they're 40% more expensive now than they were just at the end of December. Now I'm going to switch this. I'm going to look at those the greater than 90-day options. All right, so now we're going to take a look at the long term. Now remember 56 because that was a number. All right, this too has gone up, but we're talking about 40s. All right, a good 8 points off All right. So, yes, even though these are high, all right, they're still not as high as the front month. Okay. So, we're going to look at three different option strategies, and I think you'll find something in here that may meet your risk to reward tolerance. All right. But I want to show you that, that OIH there for a moment. Let's switch on back. $30 to $32 a share is what I'm looking for on OIH. And what I'm looking at is, here's the thing. Basically, we look at an historical probability, that 90% historical probability that oil moves up during this spring and summer demand. Right? You get that and you couple that with an average 15% jump in the price during a regular cycle. Now, how many of you know, have looked at the new car sales for last month? If you had for December and January, then you would know that SUVs have had a 60% increase in selling. All right. They've sold 60% more SUVs this year than they did the same time last year. Is there any coincidence of why? I mean, people aren't making that many more babies. They're simply realizing they like the room and gas prices are affording the luxury of driving something bigger. All right. Because of that, and because standard deviations have doubled this year in terms of price movement, then we should adjust our price target as well. And so I'm looking at $30 to $32. Let's go with the more conservative number, which is 30. So, real quick, for those of you that are brand new, all right, that happen to find me on my radio show or from what other way that you've made it here tonight, and you don't know anything about options, I'm going to give you a 2-minute quick blurb on this. And then at the end of the program, I'm going to talk about how you can get a lot more education on our Trade Essentials webinars, which will be coming up next month. Call option gives you the right to buy the underlying asset. That is how we rent the stock. And we do it at a predetermined price for a predetermined amount of time. Right? So think of call options. They're kind of like insurance, okay? There are different prices you can buy, either different strikes you can buy, deductibles, as we call them, different time lengths of time. And then, of course, the prices can vary based on the stock, like a car, all right? The premium on a Toyota Camry is going to be a little different than on a Ferrari, okay? And we have stocks that move like Ferraris, and we have stocks that move like Toyota Camrys, and we have options premium for both. So keep in mind that the cost to buy a call option is the premium. That's what we refer to it as. The cost and risk are no more than the premium of the call purchased. Right? So let's take a look at our first trade of the night. And this case study is using the OIH calls. So we're looking at a 25 call in July. Remember the pattern, folks. We're looking at between mid-February and mid-July. So how about a mid-July option? Right now, we looked at this at the money option because it had it does have premium and nothing but premium in it. But here's the other thing: it has the best percent to double. That means we need OIH to move the least amount of all the other strikes that we looked at for this particular option to double in value, because that's what we're looking for it to do. But we're actually looking for it to do a little bit more. So what I'm looking to do is buy to open. When I want to initiate a position in the market, I buy to open that contract or that spread, whatever that may be, and we're going to buy to open. And this case study shows buying to open in July 2016, 25 calls. Right? The last traded price that we had on here when we pulled this information together was $1.78. And let's go take a look and see where it is tonight. All right? Because it may have changed. So let's pop back on over. And we were looking at OIH. I'm just going to pop up here. I'm just going to grab my option chains. And what I'm going to do is I'm looking at OIH. And I'm going to go up. Let's move this thing up. I don't think I need to go 30%, but I'm going to put it on there anyway. And I don't care about February right now. I care about July. So I'm going to bring up the July options. And we're going to move on down. We're going to see what these July options are trading at. And so we have moved down considerably. All right. So now the July 25 calls are actually trading at 142. So we're talking about below $1.50. This is fantastic. And it's because of the big moves we saw on oil in the last couple of days. And so, consider getting OIH on sale. So $30 to $32. If we use that $30 level, that would give us right now about a Instead of a 15% return, we'd look more like a 25% return in the price of this OIH. All right, this is what the risk graph looks like on a call option. For those who've never seen it before, once we drop below a certain level, you've limited your risk. It doesn't matter how low this goes. This could go to zero, and your risk is going to be what you paid for that call option, that rental. But if we move up to 30, all right, we move past break even. We move up to 30, and we'll see that immediately we're able to note a profit. In this case, it's going to be greater than $300. Now, if we put, for example, if we put $1.78 into this trade, all right, we know we can get it for less than $1.50 now. Let's say we put $1.78 in this trade. What would happen if the price were to go up or down or sideways? And so I want to show you something that we call what-if tables. What-if tables, and we have these available on Tom's Option Tools, is a way of looking at not just these three strikes, but every strike out there and different time frames to expiration. I just pulled all this together just to give you an example of what it looks like. So if OIH is below, and this what-if table is at expiration. So if we go all the way to July and we look at these three time frames, we'll know 25 or below, our calls are worth nothing. We're going to lose $178 on the trade. And so we're not going to make anything on it. If we get to 26.28, that gives us an option, which is priced at where we are. That would be a profit and loss of zero. But if we get to 30, remember, a 25 call at the price of 30 is $5. All right, we paid $1.78 for it. We have a $322 profit. That's 160% return. Okay, so how do we place this order? I want to show you this as well. Now, again, what did I say at the beginning of this program? I am not your broker, and you need a broker to trade with, and you must meet certain requirements. And you know, there are several good brokers out there that trade options. I'm showing you one of them. All right, I am not advocating you go sign up with Options Express. I don't care if you do or you don't. I really don't. I get nothing out of it. But what I am showing you is a very easy way of placing this order using their platform. All right, and so this platform would be look like this. Your symbol is OIH. July 16, that means 2016. That's the third Friday in July. 25 calls. You buy to open. This is where you put your number of contracts. A limit order. And then let's say you want to put 2 or better. Let's say that you've looked at it tonight and you say, I want to do it for $1.50 or better. Then you put that number right in here. And then the other thing I like is good till cancels. Now, good till cancels really don't help you when you're trading inside of a week or less to between the time you enter and the time you want to get out. You're trading a 5-6 month option. Good till cancel might be great. That means you may not get filled for a couple of days, maybe a week or two, but it's out there in the event that you're away from the machine and the trade comes down and hits your limit price. All right, so that's how you'd actually place this order. And then let's say you decided, I want to put 150% return on this. So if I got filled at 2, I would get out at 5. If I got filled at $1.50, I might want to get out at a different price tag. All right, so 2, 4 would be 100%, 5 would be 150%. You could put a limit in here at 5, and then if it hits 30. Then you should have an intrinsic value of 5 here. The other thing you could do is these advanced orders, and a lot of brokers have them. You can actually put a contingent out there, which basically says if the price of OIH hits 30, then I want to get out of the trade. And you could throw a market order in contingent upon the actual price of the order. Now, the neat thing about this way of the way that we're talking about placing orders now is whatever you put in here, it does not go to the floor, all right? Especially market orders that are contingent upon time or stop orders. It doesn't go down the floor. This whole nonsense of running stops now because traders down the floor can see your orders is nonsense, all right? There may be movement around that will trigger stops, but they don't know where these things are, all right? Maybe they used to know, but now that platforms have gotten so secure and they hold your order on the server until certain actions happen, and then they send them as a market order, that's fantastic. It's fantastic for us as the retail trader. So let's talk about what else we could do. Because some of you might look at that and say, I like that trade. It's cheap, but I also know that implied volatility is high, and I also know that there may be a way that I can reduce my risk even further or bring that break even closer to where we are today. And that's with something called spreading your risks. All right, so spreading your risks involves buying, in this case, we're going to look at a debit spread. and that's conducted or constructed by buying a lower strike call and selling a higher strike call. And we use the same expiration date, and what we do is we combine what we bought with what we sold to make a smaller price. And so the cost and risk of the call spread is limited to what you pay for it and what you pay up to expiration, and the maximum reward of the call spread is limited to the amount of the spread, the difference between the spread minus what you paid for it. So if you're putting on a 10-point spread and you pay $2.50 for it, you take 10 minus 250, and you know what your maximum reward is. All right. It's also obtained at or above the strike you sold by expiration. This is an example here of what a spread trade might look like. So you would buy the lower strike call, let's call it the 25 call, and you'd sell the 30 call. All right. The combination of the two gives you what's called a spread price. What you want is you want the stock to move up and get at or above the strike you sold, because then you get closer and closer to your maximum reward. All right, so different strikes, but same expiration date. Here's our case study number 2, using again OIH. So OIH, we're going to look at that same option, that same 25 call to buy. However, what we're going to do is we're going to hedge off some of that costed risk by selling the 30 call. When you put this together, you're looking at $1.30 on this particular example. All right, so $1.30 risk. We're taking away a good 48 cents from $1.78. That gives me $1.30. And from there, I'm simply looking at, this is example, buy to open the July 25 calls and sell to open the OIH ETF July 30 calls. Buy to 25, sell the 30s. All right. And again, we're looking at selling to closes above position at the target price of 30. The difference is we're hedging off a good deal of that cost. So we're making it lower in price. We're also making this lower in terms of break even, because your break even now comes closer to where the stock price is. Now, in this case, what we'd be looking at is if we were to put this trade on, let's say we put a limit in at $1.50, then I'd know that my $1.50 would be the most I would pay for this particular spread. And then the maximum reward would be, if this is 5 points, remember, back up here a second. We're buying the 25, selling the 30. There's 5 points between a strike. If we did this for $1.50, then $3.50 is the most you'd make, because again, what's the distance between strikes? 5. Would you pay for it? $1.50. What's the maximum you could get? $3.50. So that's our call spread risk graph. And again, if we go to the what if tables, once again, we can see that below 25, we lose money. On the spread, we lose money on the call option that we talked about earlier. 26.30 is now the break-even price based on the $1.30 that we saw on the screen recently. Okay, that would give us a break-even, but no profit. What we need this spread to do is go up in value, and if it were to go to 30 or higher at expiration day, we would be looking at a full maximum potential of 5. We paid $1.30 for that, and we would end up with $370 or a 250% return. All right. Placing the order is very similar to placing an order on a call option. The difference is we're doing what's called a spread. All right. So what are we spreading? Well, the stock symbols are the same, OIH. The months are the same. The strikes are different. We buy the lower, sell the higher. The actual type is the same. We're buying to open the lower strike. We're selling to open the higher strike. We're doing this on a one-to-one basis. That means for every call you buy, you want to sell an additional call with that higher strike price. This is a debit order. That means we're going to pay for it anyway because, again, the call we're buying is more expensive than the call we're selling. And we put that limit order in, all right? And from there, we put that limit in, and it would become a good till cancel order. If we didn't get filled today, we may get filled tomorrow, next week, whatever that may be, all right? So what this does is this allows us to purchase the actual spread. When you want to exit and close this position, what would you do? You'd simply sell to close what you bought to open. You would simply buy back to close what you initially sold to open, and you're basically reversing the order. You would put that in as a credit, because when you buy it, you're paying for it. When you sell it, you're selling it for a price, and you want to get said price on a credit. So that is placing the order on a spread trade. Now, Jay, are there any questions that you see at this point that that you'd like me to quickly answer before we move into our trade, our next trade?
I think I think you're ready to go on into your trades. I think everybody's
Cool.
kind of
Hey,
asking some questions
I
about.
see John. I see John in the room, who I haven't seen in a long time. John, I'm gonna give your last two initials AB, so I don't throw you under the bus there. But good to see you in here. I how's your wife? How you guys doing? Good to see you. I see so many people in here that I see all the time, but every once in a while I see somebody I haven't seen in a while, and just gotta do a little quick shout out. So anyway, I do shout outs to all of you guys. We'd be here till midnight tonight. I promise you that. Okay. So now the last trade I want to show you guys. Let's take a look at the next one, which is a butterfly. I call this a double loop trade because we're kind of looping around from strike to strike to strike. And so you may know it as a call butterfly spread. This is going to be an out of the money butterfly spread. So we're going to look at this. This is going to take a little bit of time to talk about, not much, but again, we're going to talk about these in much, much greater length next month in the Trade Essentials webinars, which are free, by the way. They're for you who showed up here tonight. I'm going to be sending you invitations to that 3-week course that we're doing. All right, and it will include much more detail. We're actually going to talk in length on specific strategies, and the same thing using related real-time case studies, kind of like we're doing tonight. All right. So this is a 3-option strike strategy with the same month. So guess what? No, we're not going to use the 25, 30, and 35. For any of you that are already throwing that out there, not going to happen. And there's a reason why, but I'm actually going to look at something else for this particular case study. But what we're looking to do is we're looking to buy to open the lower and higher strikes. Those are the wings. And we're going to sell the body in the middle. Now, what's interesting about this one that most people or most things you'll read about in a book on butterflies is that we are using this as a directional strategy. All right. Most butterfly traders will tell you, oh, you just sell it where the stock price is. You buy above and below, and you hope the stock price goes sideways. Look, in this market, nothing's moving sideways. Not even the US dollar. All right. Everything is moving. So what we want to do is we want to create that target, and we want to put the body of that butterfly in the target zone. All right, and I like to always refer to this as if you've ever watched The Price is Right, there was a game on there. I think it was called Rangefinder. I think I really like that name, Rangefinder. And what happens is that as the it would move up, and once the person that was on stage thought that it was near that price, they'd hit the stop button. And then, of course, Bob Barker would flash the price, and they hoped it was in between the range so they could win the car. All right. What's this got to do with butterflies? Well, we want the range of that butterfly. That's in between the actual strikes that we're buying, the one at the bottom and the ones for protection at the top. That we're in that range. And so you can see here is an example of what this butterfly risk graph would look like. So this is an example where we're buying the lower strike. All right, we're going to sell the middle. Now, when you sell the middle, for those of you that are brand new to this, you're going to sell 2 times. Buy 1 contract, sell 2 contracts, and buy 1 contract. What you've done is you've got 2 long contracts and you've got 2 short contracts. All right, so they offset each other. I like to refer to this lower wing as the worker. This is the one that lifts the work, that does all the work. This lifts the spread into a profit potential. This guy up here is just for protection in case things get out of hand. And these are the income or the income strikes right here. So this will go up. We expect these 2 to go down. I expect this one to expire worthless. I don't want to see a dollar on this one. I don't want to see a dime on the top. I don't want to see a dime on the middle. I want the one at the bottom to be worth something. I want the rest of the spread to be worth nothing. Now, that isn't always going to happen. All right. But we set it up where before you get to a loss up here, you have to go through Profitville. All right. So keep that in mind. Now, let's put this to some real strikes and a real asset. And that would be my bonus trade number 3 for you, which is the double loop. And what we're looking at here is XLE. This is the Energy Select Sector Fund. All right, XLE. That basically is the energy the energy sector. And so the energy sector is trading in around the low 60s right now. And what we're looking to do is we're looking to place this. Actually, no, I apologize. I'm looking at the low strike, and I'm sorely mistaken. The XLE is trading in the mid 50s. All right. So what we needed to do is we needed to move from the $54 area that it is at today to 65. But here's the best part. I'm using January options in 2017, all right, because energy sector seems to lag a bit on the oil markets. So we want a little more time, and we want to do this at a really nice price. And so what you're seeing here is you're seeing the 60, 65, and 70 call options. We're going to buy to open one of the 60 calls. We're going to sell to open two of the 65 calls. We're going to buy to open one of the 70 calls. All right. We're looking to trade this as a single spread. So when we do that, we put that whole thing together, we'll look to close this out if XLE reaches 65 or by January 20th, 2017. Now, how's this going to look when you put it into your platform? But by the way, let's go ahead and do that first. And then I want to show you, let me show you the risk graph. So this is what the risk graph looks like. It's exactly the same risk graph I just showed you. It's just now I have numbers in place. And you can see XLE, this area right here represents the 60. This area represents the 65. That's the sweet spot right there. This area represents the 70. All right. Last week this was $37. All right, or the beginning of this week, $37. All right, for this trade, which can max out at $462. That's a 1,250% return. Okay, and this is what the what if tables look like based on 37 cents. All right, 60 or less, we lose the 37 cents. Between 60.37 or 60.63, if we hit either of those two numbers at expiration, we break even. In between those numbers are where the money's made, and the sweet spot is at 65. At 65, the spread is worth $5. If you paid 37 cents for something that's worth $5, you have a 46-cent or $463 dollar return, 63-cent profit, $463 return, $1,250% return on investment. Now, let's look at placing this order, and let's go out and see how much this trade can be was closing at tonight. Placing the order again, it's 3 line items: XLE, 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 Jan 17, Jan 17, Jan 17, 60, 65, 70. All right, these are all calls. Buy to open, sell to open, buy to open. 1, 2 to 1. This is let's say you did it at 50 cents. Right, still 900% return, max return. 50-cent debit. Again, we want to do this as a limit debit. Opening, we'd be opening all sides and put it on as a good till canceled. Now, let's see what this thing can be done at today. So I'm going to pop on over here. I want to change to XLE. XLE. And XLE, let's go ahead and we're going to look all the way down here to January 17. Because again, I don't concern myself with these short terms when I'm looking at a longer term pattern. All right, there's 53.86, 65. And look what I've got to do. I've actually got to go up farther. I've got to go up farther. I need to take myself. Let's go 50% on this one just to get all the strikes necessary and then some. There we go. Remember, 65 is our sweet spot. So we've got 60. May have already had that there in the last case. 65 minus 2, 70 plus 1. So I've got my 60, 65, 70 butterfly trade. Let's go ahead and risk graph plus that. Someone asked me what plus means versus risk graph plus. Risk graph is when you're using low speed internet, and risk graph plus is high speed internet. That's all there is to it. $53 as of today, so it's close to the $50 move. But I've seen this one gyrating anywhere from we've seen it as low as in the 20s to as high as $1. Okay, so keep that in mind, and that's why limit orders work really well. And you could put those on, take those off. Walk limit orders are really interesting too, because you can actually throw a low limit in there and then pull it, throw another one in and pull it, throw another one in there and pull it. It's automatic, right? There's check with your broker and see what they'll actually allow you to do. So those are some really neat different things that you could do there. All right, so let's see what we have here. Ben wants to know when I'm doing a series of diagonals. I don't know that one yet, Ben. Give me some time though. But you know what? We'll try to put something on the books for later in the year. Let's see. Stefan is asking how the manual's coming along. So for those of you that don't know, we're putting together a brand new brick, if you will. The option traders trade like a one percenter options manuals. We're putting those together, and the plan is that we have those. That we pulled them from the printer because I wanted to go color. Every manual that I've ever seen, since I've been around, has been in black and white, and all of this stuff that you see here is all colors, and I want to make sure you see the colors, and so we're redoing it. The costs are a little bit higher. Actually, the costs are a lot higher, but it's worth it. I'd rather put something out there that's good and not not some. I mean, it's going to be good regardless, but I want you to have it in living color. Okay, so taking a look at the other questions. Do you see anything out here that I might be missing, Jay?
You got the one on the manuals, and that was the one I was trying to address real quick there, and then you got Ben on diagonal. So,
all right, yeah, we got some smart people in this room. We don't have dummies in this class.
No, sir.
We already have one percenters. One percenters, and I mean by when I say one percenters, I'm not talking about the Donald Trump 1%. I'm talking about trading like a one percenter. All right, thinking about liquidity, thinking about timing, thinking about what works and what doesn't, and trying to be on the 1% of the group that's on the opposite side of a trade. The 1% of that group who's thinking about something other than I think it's going up or I think it's going down. All right, and I'm not going to be right all the time, guys. I mean, I got to tell you, I got hosed in the bond markets in the last couple of weeks because everything I had looked at bonds going down, and of course, what my patterns did not recognize is what was going on in China, what was going on in Europe, and how much foreign money was flowing into our treasury bonds. I'll tell you what, though, today was an absolute. It looked like capitulation in the bond market. Bonds went over $170 or 170 points on the exchange, and now they're trading below 168. So we're talking about almost two basis points off those bonds. Between this afternoon, I mean, I'm talking about this afternoon and this evening, and so it was quite a move. So. Andrew's asking, what's the butterfly going to be worth if we get there in, say, 60 days? Well, that's what these graphs here are for. All right, these graphs here are to help you determine what those butterflies are worth at that time. And, maybe this kind of comes up with the best, with the next question is, what's the best strategy? Calls, spread, or butterfly? And my answer would be, for me, it's going to be a little bit of both. Because, as hard as it is to even fathom it, is there a chance that XLE could get to 65 in 60 days? Yeah, there's a chance. All right. I think we may have to actually have a war for that to happen. But there's a chance. But if that happens, what's going to happen to your call options on OAH? What's going to happen to your spread on OAH? It's kind of what we call checkmating the oil market, if you will. So that's a good example that I wanted to show you. And so let me jump back over here to the order on the butterfly again. And so placing the order on the butterfly, once again, what you're doing is you're just looking at all the options that are in January 2017. You're spreading your strikes from 60, 65 to 70, all calls. We're buying to open the 60s. We're selling to open 2 of the 65s. And we're buying to open 1 of the 70s. Right? You do that for a debit. And 50 cents is a price that I like. All right. Again, I'm not giving you investment advice. I'm merely showing you this case study. While the markets are closed, you can evaluate it for yourself. Maybe you might decide that you want to do the 60 or the 55, 60, 65. Maybe you might want to do 10 points apart strike. It's completely up to you. All right. But what we've done tonight is we've talked about infusing a seasonal strategy that's between February and July, one that lasts a little bit longer in the energy markets, and matching the right strategy to that belief pattern, that system, whatever it is that you utilize in your trading. So, I want to do a summary real quick with you, and then I want to give you some freebies. So, the first thing is nothing works 100%. You guys all know that. If you don't know that, you've never traded options before. All right. So remember, it's not about a few weeks; it's about the long term. Last week I was in a live event, and I was jumping into a trade ahead of earnings because the pattern looked good and the risk to reward looked good, but it did not work out. And I gotta tell you, it's like getting egg on your face when you're in a room with a bunch of people and you show them this belief system you have, and it doesn't work. Hey, it happens. All right. I'm the first one that's going to sit there and raise my hand and say, it didn't work. But here's the thing. That was a trade that I took after 10,000 other trades that I took. And it's also a trade that I took that's before another 10,000 trades. So it isn't about one trade. It isn't about a few days or a few weeks. It's about the long term. All right. In fact, today I was back on that program today. I got vindicated because my Tesla trade, which was the same exact strategy, had the opposite effect, which was the effect we were looking for. And it's all about a series of trades. See, the worst thing you can do as a trader, folks, is you run into a couple losses and you go, oh, that's not working. And you go jump on something else. And guess what? You're going to jump on it at the wrong time. Oh, that's not working. Maybe I should go long term. Oh, that's not working. Maybe I should sell options premium. Maybe I should sell naked puts. Then you'll find out if it really works or not. But the fact of the matter is that rules-based trading, to me, is one of the best ways of doing that. And to do rules-based trading means that you have to trade in good times and in bad, because your belief system, your long-term of that particular strategy is a net positive. Bullish energy opportunities will take longer than a month to work out. All right? It's kind of like that old adage. Maybe you've heard it before. The bull takes the stairs and the bear takes the elevator. Right? And the bear has certainly taken the elevator in a lot of stocks in a lot of sectors, including the oil market. Right now, the bear looks like it's in the basement and it's trying to find some footing in the oil markets to move higher. And in fact, as of tonight, we're about almost 5.5% higher off of those comments that came out this afternoon. Maybe it's the start of something. Maybe it's just another head fake. We will find out. But we are in a pattern which has worked 90% of the time over the last 10 years, including, all right, did I get your attention? Including what happened during the financial crisis in 2008, 2009. And finally, like I said before, rules-based trading, to me, it's worked better than anything else that I've found in my 30-year trading career. So, we handled Q&A. Jay, do you have any other questions that you see there that are the popular ones that everyone is asking on this? Because if not, I want to give some freebies out.
Not so much a question, but Harry's yelling, "No naked options." Because
you've always. I'll second that.
Yep.
Right. You know what? It's 1 minute until the Democratic debate starts. So, I promise these guys I'd get them out of here soon. So just give me a couple minutes, guys, because this stuff that I want to give you right now is important. So here's what we're going to do for you. As a thanks for being on our program tonight, number one is that you will be getting the Energy Opportunities Report and Outlook, all right? Trading the energy markets like a one percenter. This details everything I discussed in this webinar. By the way, the webinar is being recorded, and I will send a recording out, and with that recording will be this book. You don't have to sign up for it, all right? I'm not going to make you opt in for anything. You're here. You get it. There's no reason for me to make you do that. So we're going to go ahead and get you the energy report, and that's a 20-page report. I think you'll really like it. There's also some stuff in there, a little bit more stuff in there. I think there's a shorter-term trading opportunity we're looking at the end of the month. But I'll save that. That's a secret trade. All right, you got to read the report to get it. It's in the back. Next, a couple other things. Some more free stuff. So you got the Energy Opportunities Report. We've got some free videos. And if you go on to tomsoptiontools.com, just go to the login page. You don't even have to log in for this. I want to show you so here's the login page right here. And if you look right here where it says check out Trading Essentials videos using tomsoptiontools.com, we have we did this for the first time earlier this year in January. We did this these 3 weeks of videos, and you can see these videos. We're going to do something similar. There will be differences. There will be a different strategy that we're going to teach, a couple different strategies we're going to teach in here during this next 3 weeks. But I thought what I'd do is prime you for those of you that want to see what it is we're doing in our Trading Essentials webinars. Our plan is to do a group of these webinars every other month. All right, so we did them in January. The next one we're going to do is in March. And so I want to make sure you're aware of that, and I will get you that. Jay, you know what? Do you have that? Do you have that thing? You have the webinar link?
Yeah, let me paste it into the chat window right now for everybody.
Well, let's see if I can do it before you. Did it. All right, so you can click on either the one I gave you or the one Jay gave you. It'll take you to the same place. So I'm going to click on it right now, show you what's going to happen. You're going to come to this registration, and you're going to see me up there with a handsome-looking fellow. I have no idea, but it's our 3-week options course. All right, all about calls, all about puts, all about spreads, and we're also going to go into credit spreads as well. That's our wild card week, and so if you sign up for that, you'll be in. And we'll be happy to have you there. You'll only have to sign up once, because once you sign up, your registration link is good for all 3 weeks, and we'll remind you every week when we're starting. All right, these are on Wednesdays at 8 o'clock. All right, so that's the second freebie I wanted to let you have, or was that the third? So let me make sure I got everything here. Oh yeah, you got energy opportunities. We talked about videos. And you can click on the videos, and I gave you the link to our Trading Essentials webinar. I'm going to email that out to you also. And we also have a free trial of the trading tools, okay? So the trading tools, what do they include? Real quickly, I'll spend 60 seconds showing you. So once when you log in, we've got option trading. We've also got some, if you notice here too, we've got something called Darknet that you can play around with. That is our Elliott Wave, okay? Because we found that Elliott Wave strategies, the wave counts change a lot. So what we did was we created a contrarian trading strategy that will allow you to come in and look at this information and see those particular trades, all right? And we have B's for buys and R's for rebuys and S's for sells, all right? And yes, we actually have back testing on this as well. And the overall pattern is really the probability is quite high on this. All right, this is about a 20 to 30 day trading strategy. I want to make you aware of that. We have the money calendar in here too, and the money calendar is another tool that we created a couple years ago. In fact, this one's in the form of getting a patent, and it is basically we're looking at seasonality on stocks, and you just come down and you pick the day that you're interested in. So for instance, next week's the 16th. If I click on the 16th, I can see all of these patterns in effect that have 90 to 100% historical accuracy. And then I can go out there, I can say, oh, let me take a look at how about Priceline? PCLN. Now come down here and I see all the years that this pattern was in place and the money that it made during those years. We can look at last year. We can see there was an earnings report that bumped that up. Actually, in the middle of a pattern right now at Priceline, and we're expecting that same thing to happen. All right. So this is a 100% last 10 years. During this time frame, this has actually ended higher by the time we got to the end of the particular trade. There's plenty of option tools. There's so much in here that you can look at. I'll also, if you're signing up for the free trial, I'll also send you along a video series on how to actually use the software during that free week that you have there. So guys, that is it. I am done. I want to thank you all for being part of our webinar tonight. And again, you have some great stuff to look forward to. And more importantly, be on the lookout for an email from me that will include the report, Energy Opportunities Report for 2016. I'll also give you links to the videos. I'll give you links to the free trial, and I'll give you links to the most important part, which is our 3-week option course, which all of you in this room have earned. I want to thanks you for being here. Jay, thanks a lot for backing me up there, buddy. And
you're welcome.
You guys all have a good night. And, feel free to email us, support@tomgentile.com with any questions or comments that you have. Have a great night, and I'll see you soon.